To the urgent work of getting the pandemic under control as his election win is confirmed by the Electoral College. And Credit Suisse will restart share buybacks of up to 1.5 billion Swiss francs in January. It also sees fourth quarter investment bank revenues ahead of the previous year. Matt?
Take a look at futures. We do see a drop on, a drop across the board. FTSE futures falling further because of the strength of the pound right now, but you also see DAX futures down only by 0.1%. So, as the markets open up, let's take a look at the global macro movers screen. You have a number of risk assets here in each column, and on the left-hand column, you see the equity indexes. That column will populate as they start trading live. So the FTSE down 0.1% out of the gate. The IBEX up 0.1%, and then dropping by the same right away. So a little bit of volatility at the start of trade. And of course, you got the Inditex numbers and moves, if it has indeed opened up already, which will swing the entire Spanish index. The CAC Corral down 0.1% as well as the FTSE falls further, now down about 0.4%. So European markets opening generally lower, although not huge drops here. There is caution about the economic risks of the virus-related curbs that we see in Germany, in London, in the Netherlands, as well as the ongoing U.S. fiscal stimulus talks, a little bit of pessimism there. The MSCI Asia Pacific, meanwhile, is set for its worst drop this month. In case you're looking at Asian stocks, a lot of people may see that as a buying opportunity. Joining us now is Kurt Custard, Newton Investment Management CIO. And Kurt, before we get to the possibilities in Asia, which a lot of people have been telling Anna and myself about over the last 24 hours, let me ask what you think about Europe. We have more restrictions going into place, harsh restrictions here in Germany tomorrow, I believe in London as well. Overnight, they'll go into a Tier 3 lockdown. The Netherlands is tightening its curbs. We hear New York City may be looking at the harshest lockdowns as well. What does this do to your investment strategy? Does it change?
It doesn't change a whole lot because we're pretty long-term investors. I do think that the market has already discounted a lot of really good news. And while I expect the vaccine to be successful and the rollout to be successful, I'm not so sure we're going to see further price action in the market. So, any further lockdown is just going to depress near-term economic activity, which is just going to make that recovery that much bumpier.
What signs of, good morning to you, Kurt. What signs of normalization are you looking for in various Western economies as we see rollouts of vaccines this month, next month, into 2021, Kurt? What will be the clear signs that things are going to get more normal, even if we don't expect to live entirely normal lives in the early months of next year? What are going to be the things that will make the difference?
Well, I think it's going to be the SME sector. I mean, that's the sector that's been clearly around the world hit the most, and that's the sector that should recover the most. So when you're looking at, your local stores, right, being able to go out and walk on the high street and be able to go out and do shopping and meet your friends, go to the pub, etc. I think those are the areas that are going to be the biggest indicator that we're returning to normality. I think that some of the structural changes that we've seen are likely here to stay. I mean, the online shopping, etc. I don't think that's necessarily going away. But if you wanted to look at how society is going to return to normal, it's when we get back to socializing. Humans are inherently social creatures, and this has been a real anomaly.
Yeah, it's killing me. I have to say, I can't deal with bars being closed for another few weeks, but I'm going to have to, and it's for a good reason. I wonder what you think about the stimulus measures. Are they going to be enough to stave off a wave of bankruptcies? Are they going to be enough to reduce the harm to private economies?
I think it'll be enough to help reduce the harm. I think it's going to be very, very difficult for it to completely reduce the harm. If you were a small business and you had a highly levered business model, or you had something that required a lot of cash flow, I think you're sort of toast. The reality is the economy has shrunk. You've had a massive dislocation going on, and that's going to expose weaker business models, regardless of the size of the company. That said, I do think that there is going to be and will continue to be low rates and fiscal support for the next 12 to 24 months.
And in terms of that fiscal support, that's a long period you just cite there, Kurt. What is your expectation for the US? What does fiscal support look like there? Because it seems to be really important running into the US election. Now it seems to be a sidelined theme after we got, obviously, the vaccine news flow, which has been really incredible. But we still have an expectation of some kind of fiscal support, it would seem, built into markets. Is that your view? How material does that have to be as we see cities like New York preparing to lock down further?
Well, I think it is going to be material to that SME sector and being able to support small and medium-sized companies to be able to get back on their feet. So I do expect something to take place. I would be very disappointed if, especially under new administration, there wasn't care focused in that area. I mean, it's important to remind everybody that that's the area that employs everyone, right? And you can't have a massive spike in unemployment and remain a politician for very long. So my guess is that we'll get something done.
Kurt, I want to. We're going to keep you with us because we have a lot to talk about, including Niall Ferguson's column in which he warns about the amount of debt that governments are amassing now and what kind of damage that could cause later. You said you're a longer-term investor, so I want to ask you what you think about that theme longer term. Kurt Custard, Newton Investment Management CIO, stays with us. It's been clearly the biggest black swan event that we've seen since, the 2008 financial crisis. What are the risks that investors need to watch out for next year and in the coming years? We'll discuss some of the likely and some of the less likely risks and opportunities that we may see in 2021. That's next. This is Bloomberg.
Welcome back to the European Market Open. Tuesday morning, nearly 10 minutes into a session that looks fairly flat for European equity markets, waiting for some further Brexit news flow to kick the UK assets perhaps into action. Elsewhere, we are preoccupied, of course, by the virus and lockdown measures. Interesting to see that US futures actually point to the upside this hour. Let's get a Bloomberg Business Flash for you. Here's Laura Wright.
Thanks, Anna. Credit Suisse says its investment bank is continuing to perform well, with revenue higher in the fourth quarter of last year. The Swiss bank is restarting its share buyback program in January and sees a significant turnaround in asset management in 2021. Tech giants could face fines of up to 10% of revenue if they fail to comply with new EU rules. According to a draft seen by Bloomberg, the companies will be banned from using any data from business users to compete with them. A company that systematically breaks the rules could be ordered to divest businesses. Airbus is warning that a no post-Brexit trade deal puts its investment in the UK at risk. Chief Executive Guillaume Faury says decisions will be made based on how easy it is to conduct business after the split. In the meantime, the company has no plans to close or scale down its British operations. That's your Bloomberg Business Flash. Matt, Anna.
Laura, thanks very much. Laura right there in London with your Business Flash. Now, as I was saying before the break, Kurt Custard is with us from Newton Investment Management. And Kurt, we've had some amazing opinion columnists lately. Mohamed El-Arian writing about the dangers of negative rates. Lena Komoleva writing in support of negative rates. And overnight, Neil Ferguson talking about the debt amassed, or that will be amassed because of this pandemic. In fact, he goes as far as to say, or the CBO, he quotes the CBO's baseline projection that says the federal debt in public hands will reach, in the U.S., 195% of GDP by 2050, nearly twice as high as the end of World War II. This is happening in countries all over the Western world, Kurt, and you said you invest with a long-term look. How do you factor in the amount of currency devaluation that Western central banks are inevitably going to aim for?
Well, what's interesting, it's not just the West. China also has a massive debt problem. This is a problem around the world, and there aren't a lot of ways out. It's one of the things that we discussed actually a fair amount. The debt levels are so large now that central banks cannot really afford to raise rates, and they've painted themselves into a corner. If they raise rates, they're going to raise corporate borrowing costs. That's going to slow the economy. So they have to keep rates sort of ultra low for a long time. So what's the solution there? Well, the solution there is probably inflation. And we did see that post-World War II, and I think we're likely to see that going forward. It's interesting to me that central bankers seem to be backing off their 2% target because we've had such low inflation for so long that they're willing to let inflation run hotter for longer, and I think that's likely to occur.
And so does this mean, Kurt, that we can see a path forward that very carefully threads the needle, where central banks allow inflation to be just high enough to try and help us work through this debt burden, but at the same time inflation does not get out of control, so central banks do not need to hike up interest rates really substantially? We're placing a lot of trust then and making a lot of assumptions about how these dynamics move together.
You're absolutely right. And if we were rolling back the clock 15 years ago, to pre-GFC or something along those lines, I would say that this would be almost an impossible needle to thread, because the markets have a tendency to extrapolate current trends and just, race on with them. And so you'd see people starting to freak out about inflation, bond yields going back higher, et cetera, et cetera, et cetera. Back to the old days of the bond vigilantes. But now they have a new instrument to prevent that from happening, which is they go out and they directly intervene in the marketplace. And so you have this sort of weird circumstance where the fixed income markets in particular are very manipulated. And as such, they may prevent yields increasing just by directly intervening in the markets themselves.
It's funny because it reminds me of the Ben Bernanke 60 Minutes interview in which, right after the financial crisis, he said that the central bank has no problem controlling inflation. They can stop it anytime they want. And of course, investors find that difficult to believe. Do you make certain investment choices in order to hedge against the possibility of runaway inflation, Kurt?
Well, certainly we think market fear is going to manifest in the markets about inflation. So you're going to see things like gold rally. You're going to see alternatives to fiat money rally. So the cryptocurrencies, etc. You'll see tips begin to rally versus nominals. So I think those things are absolutely going to have an impact and move. And we do invest in those. We've been big investors in gold for a while, specifically on this fear. Whether that materializes or not is a really interesting question. And I do think central banks, 5 or 10 years from now may have a lot to answer for.
So central banks might control the curve in this new world that you described, Kurt, by actively being involved in these markets, in these fixed income markets. But do they really control inflation then by doing that? Because we've spent years talking about why inflation in many parts of the West was so much below target. Now, if we face the opposite problem, if inflation does spike up and goes above target, will central banks be able to bring that down with the tools we know about?
Well, I think the jury's still out on that. And there's one thing that I think has sort of flipped the script, if you will, on inflation, that we've seen a lot of inflation over the last, decade and a half. It just hasn't been goods inflation. It hasn't been CPI. If you include the asset markets in there, we've had a tremendous amount of inflation. I mean, the S&P is up 15%, in a backdrop of a global pandemic. I don't know what that is other than inflation, right? So there has been a squeezing of liquidity out of the real economy and into the financial economy, largely directed by monetary policy authorities. And I think that they're going to have to walk a very thin line to make sure that doesn't reverse and go back into the real economy going forward.
All right, Kurt, thanks so much for joining us. Pleasure talking to you today. Kurt Custard, Newton Investment Management CIO. He's going to be continuing the conversation with Anna and myself on Bloomberg Radio as well at 9 a.m. UK time. So in just about 44 minutes, tune in on London DAB to catch more from Kurt Custard. Now coming up, even lower for even longer. As Kurt was just saying, we're going to speak to Lena Komaleva of G Plus Economics about why she thinks the ECB still has room to cut rates even further into negative territory. That's next. This is Bloomberg. Welcome back to the European Open. We are 20 minutes into the session right now, looking at European equities that are, well, the FTSE is lower, as you can see. The DAX and the CAC are a little bit higher right now. Taking a look at some of your movers, CD Projekt is gaining after, well, it fell 33% over the last few days. There were some glitches in the new long-awaited cyberpunk game. You saw Laura Wright's interview with the CEO on that. No multiplayer version yet. I hope it comes out quickly. Volkswagen, you can see those shares rising 3.4% here in Germany. The board has backed the CEO and also said that they will keep Lamborghini and Ducati. And I'm sure investors are cheering that fact. The importance of Ducati's new V4 motor can't be overstated. Speaking of motors, Rolls-Royce, the airplane engine maker, has been cut to a sell at Panmure Gordon. The analyst has given Rolls-Royce a price target of 52 pence. You can see it trading right now at 114.50, far above that. Anna?
Matt, let's talk about the case for negative interest rates. As European governments are forced into stricter lockdowns over the Christmas period, Lena Komaleva says that Eurozone borrowing costs could fall even lower, while some fear that if rates go any further below zero, it could cause a run on the banks. She argues that there is little evidence that the ECB's overnight rate is near the lower bound and that another cut to rates could be an appropriate response. So let's get into this conversation. The case then for negative rates. Lena Komaleva of G+ Economics, where she's chief economist and also writes for Bloomberg Opinion, is with us now. Lena, really good to speak to you. So there are a number of criticisms of negative rates. Let's go through a few of them and you can debunk them for us. There is this idea that if savers are given even lower interest rates, in this case more negative, they don't go out and spend, they just save more. Is that not what is happening in Europe?
Well, the ECB has had negative rates since 2014, and the policy remains extremely unpopular in a world of pensioners and yield-hungry investors. The reality, however, in Europe is twofold. First, we have had a chronic surplus of unproductive savings and a chronic deficit of internal demand, which in a world of deglobalization where we have a more protectionist US and a more aggressive China, is no longer a sustainable long-term growth strategy, especially in the aftermath of Brexit. So clearly more has to be done to reactivate domestic savings and to also improve the productivity of domestic capital. One way of doing that is by lowering discount rates on investment projects. But I think the key issue here is that we have had negative rates for a long time. And judging by the ECB's own projections last week for medium-term inflation following its latest extension of quantitative easing and emergency bank loans, even a strong Eurozone recovery after the pandemic expected in the next 2 years will not deflate domestic demand in the Eurozone enough to close the Eurozone inflation gap close to the ECB target of below but close to 2%. So I argue here that the ECB must do everything it can now to escape its liquidity trap, or as I call it, the debt inefficiency trap of negative rates forever, where the ECB's low rates are not low enough to stimulate demand. But at the same time, the ECB can never exit its lower for longer regime with damaging consequences for European banks and market efficiency.
Now, I'll brag a little bit on behalf of Bloomberg, Lena. We have been blessed with an all-star cast of economists writing opinion pieces for us, including yourself and Mohammed El-Arian. I was talking about his column on the ECB the other day. And I want to ask you about a specific point he makes when explaining why Christine Lagarde didn't cut rates further into negative territory. In his column, he says, "I suspect that this reflects deepening recognition that this element of the policy toolbox is now seen correctly as delivering few benefits while risking considerable collateral damage and unintended consequences." What do you say to Mohammed?
I think that Mohammed El-Arian is a highly respected financial expert, and there is absolutely no doubt here that the longer negative rates remain, the more damaging the effects become. However, the reality here is that in 2020, European governments have transferred stimulus worth 20 to 30% of GDP into their economies to support businesses forced to close and jobs put at risk due to the pandemic. Whilst last Friday, the European government finally achieved an agreement, a political contract that allows Europe to open a new chapter in its transition towards the fiscal union, it's taken the entire year. If it wasn't for the ECB setting, we would have a financial crisis in Europe this year. I mean, the collective response in terms of growth in public debt and also the negative double-digit contraction in nominal GDP that we have had in 2020 has not just overwhelmed government resources, it's exceeded the combined shocks of the global financial crisis and the Eurozone sovereign debt crisis of the past decade. So what negative rates have done in Europe is, I call them the great equalizer. The overnight deposit rate was the benchmark for money market rates, which in turn became the benchmark for European government yield curves. The result is that we have the developed world's most vulnerable borrowers, Greece and Italy, borrowing at rates that are below the US's. This is an exceptional thing, and this is all down to the ECB's policy setting. There's one more thing, actually, many more things, and I explore these in the article, but there's one more thing to note here. The way that policy works, and I know that Mohammed knows this very well, is it works on the premise that output is demand determined. And if we have an output gap, this results in a gap between expected inflation and actual inflation. In other words, what the central bank must do is it must set the policy rate level below the economy's equilibrium rate, which is depressed at the moment in the Eurozone through this double-digit negative GDP growth, through the shock of the pandemic, through the capital destruction that we have seen this year. And it will likely remain depressed even as we go through. I mean, the best scenario that the ECB has is that we won't get to levels of 2019 economic activity for at least 2 years. That means a long period of a large output gap,
Lena, thank you very much for your time. Really good to speak to you. Lena Komeleva, G+ Economics Chief Economist and writing for Bloomberg Opinion. Up next on the programme, as EU Brexit negotiator Michel Barnier sounds upbeat on the prospects for a deal, we'll discuss the future of global trade. Our interview with Pascal Lamy, that's coming up next.
Welcome back to the European Open. We are 30 minutes into the trading day right now and looking at a stocks Europe 600, the broader European benchmark, just barely treading water right now, up about 5/100ths of 1%. Let's get the Bloomberg First Word News. For that, we go back to London and Laura Wright. Laura?
Thanks, Matt. Joe Biden is now officially the president-elect after the Electoral College confirmed his victory. It puts him over the 270 votes needed to win, and he will be inaugurated as the 46th president on January 20th. Speaking after the vote, Biden noted his 306 electoral votes is exactly the same number President Trump earned in 2016.
At the time, President Trump called the Electoral College tally a landslide. By his own standards, these numbers represented a clear victory then, and I respectfully suggest they do so now.
London is being hit by the UK's toughest restrictions from Wednesday, and UK authorities are warning of a new variant of coronavirus which may be driving a rapid rise in cases. The switch to Tier 3 means pubs and restaurants will close except for serving takeaways. Health Secretary Matt Hancock says the new measures are essential to protect lives and jobs in the longer term. China's recovery gathered pace in November, supported by strong demand from home and abroad. It puts the nation even further ahead of its peers as the only major economy likely to expand this year. Exports have rocketed in recent months. The return of virus restrictions in many parts of the world has fueled demand for medical equipment and electronic devices. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Matt, Anna.
Laura, thanks very much. Laura Wright here in London. Let's get more on the future of global trade. The EU negotiator Michel Barnier reportedly telling a meeting of ambassadors that a trade deal with the UK could be completed as soon as this week. Could. The year is pretty much ending like it started, with Brexit making headlines. More widely, how will the pandemic and the economic response to it reshape trade flows as we move into 2021? Lots to discuss then with Pascal Lamy, former WTO Director General and President Emeritus of the Jacques Delors Institute. Pascal, very good to speak to you. So I'll start with a Brexit question and we'll build to other topics. Do you see a landing zone around level playing field between the EU and the UK? Can you see conceptually how it is possible to shape a deal on the level playing field?
Yes, I think so, provided Mr. Boris Johnson is a bit clearer on what he means by Brexit in economic terms. We know we have a political Brexit. What we don't know is how much of an economic Brexit will we have. And by this, I mean that within Europe, we've removed borders a bit of time ago, at a time where we decided we would exercise the same level of precaution among us on safety, on security, on people's digital rights, on pesticide residues, size of bumpers, diplomats for nurses, and the rest. So it's a big integrated ecosystem, a big omelette in a way. And getting the UK eggs out of this omelette is inevitably complex. So how much does the UK want to diverge is the real issue. And the fear on the EU side is that UK would exercise a level of precaution which is below the European one, thus impeding normal free trade and trade flows. So the EU wants to know where, when, how much will the UK diverge? And of course, this is a question which is a hard one in UK domestic politics.
Yeah, I mean, otherwise they could run into the kind of problems, the EU could run into the kind of problems that they currently face in terms of huge digital players. And I want to ask, especially in light of the lockdowns, Pascal, that are closing all of the brick and mortar stores, or at least reducing the amount of revenue they can possibly hope for, as consumers do all of their shopping via Amazon and Google, how does the EU. France has made a lot of noise about this, especially recently. Deal with the taxation of these big tech behemoths.
Well, I think it was a question already there pre-COVID. And given that COVID has projected us 5 to 10 years in the future on the speed of digitalization, it's even more a question now. These big tech digital companies have gained market share, and the fact that they don't pay taxes, or very little, which was a problem before COVID, will be even more of a problem after COVID. This is not just a European problem. This is a problem everywhere. I think this new model, this new digital economy, which, as you said rightly, is different from the traditional brick and mortar one, should pay taxes like the rest of the economy. There's no specific reason why they would be exonerated.
Okay, and with that in mind, do you expect France, though, to hold off on imposing digital sales taxes at the end of the year whilst we wait for a more global solution, something coming through from the OECD? Is that the right forum?
Absolutely, I think that's correct. The EU is trying hard to work within the OECD to get a internationally agreed new set of rules that would lead these companies to pay taxes. If this moves, fine. If this does not move, then the EU has kept the right to do it by itself in order to, in a way, show the way after having tested the goodwill of others.
I wonder who you think, well, I won't ask who should be supported as the next WTO Director General, but what should the priorities be, the top priorities in such a changing world, Pascal, for the incoming WTO Director General?
Well, I think we know the name of the incoming new DG WTO. The only question is, when will the US unlock this name and remove the veto Mr. Trump had put on the one that has been elected? This is one thing. I think short-term, Mrs. Okonjo should be a bit like sort of a kinetherapist, relax a bit muscles and nerves who are a bit tightened, and then move to the big question, which is reinstalling a proper conversation, negotiation, trust to move forward between US, EU, and China on one main issue, which is re-leveling the playing field with China. This is the number one issue. There are many others, but this is the one where a change in the US administration, moving from an extremely aggressive position vis-à-vis China to something which would be more proposing China to adopt new rules and negotiating them, would be tested. I think this is the challenge number one of Ngozi Okonjo.
What is the level playing field priority then for China, Pascal?
Now, the problem we have with China and many countries on this planet have this problem, even if only US, EU, Japan are sort of big enough to stick their neck out of the window, is that 30% of the Chinese economy is under state command, and competing on the domestic Chinese market and with Chinese competitors on the international market who are supported, subsidized by the Chinese state, is something that needs to be disciplined. It's a bit like, what we have within the European Union. We have state aid disciplines that prevent some countries to debalance competition in supporting, subsidizing some companies, and which, by the way, is one of the issues that we have in dealing with the Brexit. the situation is the same worldwide. You have a large international, big global market. Competition has to take place in fair terms, and China has to recognize that more disciplines are needed. Otherwise, trade will not remain open.
Pascal, thank you so much for joining us. Pascal Lamy, former WTO Director General and President Emeritus of the Jacques Delors Institute. Thank you very much for joining us, talking there about Brexit, about global trade, about China. Coming up on the programme, we speak exclusively to Christian Sinding, the CEO at EQT, after the private equity business made a $2 billion bid for the Scandinavian pharma company Recipharm. That'll be part of the conversation. Danny Berger brings us that Money Undercover interview next. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open, 43.5 minutes into the session right now, and looking at gains on the majority of equity indexes. You can see that Madrid right now, the IBEX is lower, but the CAC and the DAX are up almost 0.5%, and the FTSE, little change, up about 0.1%. Now, for Europe's deal makers, business is now exceeding that of 2019. Companies in the region have announced $1.2 trillion worth of M&A this year. That figure was boosted in just the past 24 hours after pharma deals announced by both AstraZeneca and private equity firm EQT. With more in this week's Money Undercover is Danny Berger, who's joined by a guest from that company. Danny?
Matt, I was about to say I'm with someone who knows a lot about that last deal. It's Christian Sinding, EQT CEO and managing partner. Christian, first off, thank you so much for joining us. It's really been a busy period for you, be it the pharma deal. You've also made large investments in other companies as well. Does it look to you like you're at peak activity levels, or heading into the new year, are there still a lot of opportunities that you're looking at and planning to pursue?
Great to be here again. I think it's both, actually. You know, the activity levels now are at record highs after a very quiet Q2. Q3 and Q4 have been incredibly active, both in the public markets and the private markets. Looking into next year, you know, we see a record pipeline of new investments that are coming from basically all sources, and also a record pipeline in private equity in general of exits as well. Of course, we're still trying to have our feet on the ground, given that we're still in a pandemic, but activity is extremely high.
Extremely high activity. Well, I wonder what type of activity that's going to be. Your announcement yesterday of Recipharm was a take private, but there's been a lot of criticism that those don't look attractive because valuations are so high right now in public markets. What do you say to that argument?
Yeah, you know, the way that we think about valuation is a little bit different. It's not necessarily what the company is valued at today. It's rather, how can we create value with this company for the long term? So what can we do to this company? How can we help it transform? How can we help it become future-proofed? How can we help it serve society in an even better way? And then create value once we exit, which is 4 or 5 or 7 years down the line. And that's the same thinking we have around Recipharm. We think it's a great platform, but we think as a private company, we can accelerate and build on that platform in a faster way.
Christian, if we're going to talk about companies that could be better as private ones, I definitely can't let you go without asking about KPN, something Bloomberg sources have said that EQT is looking at. Can you confirm to us, is that a deal, the Dutch telecom provider, that you would be interested in?
Yeah, unfortunately, I can't comment on live deals or potential deals or anything that's speculated. I can only comment on those deals that we have announced that we're working on.
Fair enough. What about the sector, though? What about Broadcom, telecom? Is that something you're interested in?
Yes, telecoms in general. You know, we're already one of the world's largest owners of broadband fiber. We took Zayo private last year in the United States for $14–15 billion. We have one of the largest broadband fiber players in the German-speaking region called Annexio and Deutsche Glasfaser. We put those two together. And they're actually rolling out fiber across rural Germany, which actually is quite important because there are a lot of people who don't have access to real broadband and good internet service there, which is of course essential during the pandemic. So we like that the overall telecom sector, but on the whole we're more focused on the future-proofed broadband fiber area.
Christian, if I can go back to something you mentioned earlier, talking about peak deal activity and exits as well, IPOs, they've been hot. We had Airbnb and DoorDash in the US to much fanfare last week. Do you think that this is a good environment to be pursuing exits?
Yes, absolutely. The IPO market is already twice as active as last year. And like I said, Q2 was pretty quiet. So we've seen record activity, and then you have all the SPACs on top of it. Actually, we took a company public in the United States last week on Friday on the NASDAQ, a company called Certara. It traded up 60% or something like this and ended up being a fantastic investment for us. We still own a large part of the company, so we're going to follow it on the stock exchange. But I think we made something like 9 times the money. And it was, again, in a very future-proofed sector. This is a company that makes software to analyze how drugs interact in the body. So I think not all sectors are hot now, but those that the market believes will come back quickly are getting hot again, and those that are really there for the long term have been hot for months now, and I think that will continue.
So what sector's not hot right now then?
Well, I think if you look at let's say the oil and gas sector is a complicated one, right? You have the decarbonization wall coming closer. You have the drive towards sustainability, renewable energy. And you still have some parts of the leisure sector, which are in travel sector, where we don't really know exactly when is that market going to come back. However, Airbnb, people really believe in that business model. So if there's conviction, you can get something done.
So, Christian, in terms of things that are hot, one of the things we're looking at right now, a chart of ESG fundraising really picking up over year after year for private equity. I know this is something you care a lot, but how does EQT differ in terms of your competitors when it comes to ESG offerings?
Yeah, when EQT was founded, we had the motto EQT more than capital. So we've always tried to be a really responsible owner are really working with the companies to develop them in the best possible way, also considering all stakeholders around. Now we say our purpose is to future-proof companies and make a positive impact. And we've even inserted that into our articles of association so that we really have to work with not just how do we create financial value with this investment, but how do we create value for all stakeholders. And actually, we think that's really symbiotic. Because if you look at two companies that are exactly the same, and one can become more sustainable than the other, which one will attract the best talent? Which one will have the best relationship with regulators? Which one will have the best value chain or the most future-proof value chain? Well, we think it's the more sustainable one. And therefore, we actually think those will be the best investments going forward. So that's how we think about it really holistically.
Right. Christian, just finally, I know when we've spoke before, you are not a fan of SPACs, but Goldman Sachs says that there might be about $300 billion worth in the next 2 years. Why is this problematic to you that we're about to see so much? And just quickly here.
Yep. Well, SPACs, there are a lot of conflicts of interest in the SPAC. There are a lot of fees going around, at entry rather than over the long term when you create value. So I think that's one of the major challenges. And then you don't really know who the owners are going to be. You don't necessarily know if the team who's running the SPAC will be able to handle the company in a great way. So I think there are a lot of questions around it. I see that it's a great tool, but it's also something I think we need to be watchful for.
Right. Well, Christian, thank you so much for joining us. That's Christian Sinding, EQT CEO and Managing Partner. Matt, Anna.
Danny, thanks very much. Danny Berger there with that interview. Up next on the programme, how reliant on the Fed are risk assets? We'll put that question to the Market Live's Laura Cooper. I wonder what she thinks the Fed is or is not going to do this week. This is Bloomberg.
Good morning, ladies and gentlemen. I'm going to place an order to sell short Canadian dollar, 127.6. Let's see if we'll be able to reach this level, and if it will go up, the order will be executed. Okay, let's see. I'll wait for 2 minutes. I'll give them 2 minutes. Nothing will happen because it's moved already quite far. I will cancel this order.
Welcome back to the European market open. 54 minutes into a trading session that's a little more positive than it was. We see some modest gains being made by some of these European equity markets. The Stock 600 as a whole up around 0.25%. Let's get into a markets conversation then with Laura Cooper, Bloomberg Markets Live macro strategist. Laura, the question of the day I know is around the Fed, and we don't see a great deal of market action this morning. A little bit of move to the upside. US futures move a little higher as well. And so that's got me thinking about what the market is expecting from the Fed. Is action from the Fed going to be the key input for risk assets, do we think?
Well, I think certainly the Fed is the highlight for the week in terms of driving action, given the fact that we really don't have any other kind of fundamental catalyst ahead of the decision. But I think we've seen consensus shift away from expectations that they're going to potentially tweak the bond purchasing program, and that's on account of just these exceptional financial conditions. But I think there is still a risk of them kind of extending the weighted average maturity of their purchases, because if we take a look at the U.S. right now, the labor market is stumbling. We do have that year-end expiry of those emergency backstops, and ultimately there is this risk of disappointing market expectations. So we could see some curve steepening on the back of the decision tomorrow if they don't follow through, if they keep some firepower through to 2021. But ultimately, I think yields are going to be contained regardless, because if they don't take action, there is likely a feedback loop. So if we do see yields kind of rise, if we do see financial conditions tighten and stocks begin to come under
Position closed for Canadian dollar, 2 minutes gone, and they had a chance to take my money. So I'm canceling. Let's see what's going to happen later. Maybe next move will allow me to enter the trade.
With new regulations hitting big tech companies and European stocks looking valuable in terms of PE levels, do you see a rotation?
I think certainly we are continuing to see that rotation trade take hold. I think we're going to see some stumbles along the way as we see these renewed lockdowns in areas like Germany and now with London. But ultimately, those attractive valuations continue to underpin kind of that ongoing rotation trade. And ultimately, these vaccine deployments do set up for a bright prospects for 2021.
Yeah. Laura, thanks very much. Laura Cooper, Bloomberg Markets Live macro strategist. Thank you very much for joining us. That is it for the European market open. The sun is shining in London. Stay with Bloomberg Television. Up next is Surveillance. This is Bloomberg.
It's official. The Electoral College confirms Joe Biden's victory. He asks Americans to look ahead to the urgent work of getting the pandemic under control. Curbing the virus, new restrictions threaten major economies. London is set to enter Tier 3 rules. New York could see another full lockdown. And Credit Suisse will restart share buybacks in January. It also sees fourth quarter investment bank revenues ahead of the previous year. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Acqua here in London. Now, the markets, of course, are focused also on Brexit. We look at any kind of pound movement, and then over in the U.S., we look at the stimulus bill, if we get it, when we get it. We also talk about Michael Barr. Now, overall, the markets see a bit of a risk-on mood. If you look at European stocks, they're gaining some 0.3%. U.S. futures certainly rebounded after a slump. Partly was some of the mixed trading that we saw in the U.S. and Asia, but also there are these lingering worries about tougher lockdowns. If you look at the contracts, the futures, they seem to give a hint that investors' optimism is back after a bruising session on Monday. Again, if you look at the number of cases and you pit it against the economy, it makes for an interesting reading. Oil dropping from a 9-month high on concern that virus restrictions will once again mean less travel. Now let's get straight to the Bloomberg. First word news, here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. London is being hit by the UK's toughest restrictions from tomorrow, and authorities are warning a new variant of coronavirus may be driving a rapid rise in cases. The switch to Tier 3 means pubs and restaurants will close, except for serving takeaways. Health Secretary Matt Hancock says the new measures are essential to protect lives and jobs in the longer term. Now, New York is also heading towards a second full shutdown. That's according to Governor Andrew Cuomo. He says the new rules will come into place if cases and hospitalizations continue at their current pace. Mayor Bill de Blasio is also warning of new restrictions and urging employees to work remotely where possible. Government agencies and major corporations outside the U.S. are reviewing their computer systems for signs of security breaches. That's after a hacking campaign inserted malware in software updates from computer company SolarWinds. It is more than 300,000 customers worldwide, including the UK's National Health Service and NATO. And China's recovery gathered pace in November, supported by strong demand from home and abroad. It puts the nation even further ahead of its peers as the only major economy likely to expand this year. Exports have rocketed in recent months. The return of virus restrictions in many parts of the world has fueled demand for medical equipment and electronic devices. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, Joe Biden is now officially the president-elect after the Electoral College confirmed his victory. It puts him over the 270 votes needed to win, and he will be inaugurated as a 46th president on January 20th. Now, speaking after the vote, Biden noted his 306 electoral votes is exactly the same number President Trump earned in 2016.
At the time, President Trump called his the Electoral College tally a landslide. By his own standards, these numbers represented a clear victory then, and I respectfully suggest they do so now.
Meanwhile, U.S. Attorney General William Barr is stepping down. That's after publicly disagreeing with President Trump's claims of widespread voter fraud at the 2020 election. Trump confirmed the move on Twitter, saying Barr has done an outstanding job. He'll be succeeded on an acting basis by Deputy Attorney General Jeff Rosen. Well, joining us for more is our senior editor, Derek Wallbank. Derek, great to have you on such an important day. So the Electoral College has finally voted. Is it finally over?
Well, the President of the United States doesn't think so, Francine, because he spent much of the overnight, tweeting very late into the night, retweeting people who were trying to urge a continuing on of the fight. There's been no signs from the President of the United States that he is going to stop here. And indeed, some of his high staffers were talking about this not being over. For the rest of the world, it mostly is. You're starting to see some Republican lawmakers, some senior ones, not all, but some senior ones basically say, look, this is over. There's no way anymore. Some others say there's not really a path. And in any other election, Francine, I would say, especially the one most people think about, 2000, Bush versus Gore, this is where it ended. right now. Is Trump going to continue on it? It looks like he will.
Okay, he'll continue on it, but when will he leave the White House, and how will he leave the White House?
Well, he's not going to be president anymore on January 20th. The last thing that really people should be watching for is a usually routine Congress accepts the results of the Electoral College. That's going to happen the first week of January, and there's a procedure where maybe someone can try and challenge votes. We haven't necessarily seen that any senators on the Republican side are going to go along with what some House Republicans are looking to do. And even if they do, it doesn't appear likely at all that Trump has a chance in the world of overturning this result. But as I say, it's not stopping him fighting. And even though Biden is trying to move on with everything, he's still kind of not getting a free, clear slate to do that. Even as all of the votes are counted, they are what they are. Joe Biden won.
How significant is William Barr stepping down right now?
Well, I think it's quite significant, actually. And you mentioned in the introduction that he and Trump had fallen out a bit over not being willing to go as far as Trump wanted on the voter fraud stuff. Barr has said flat out there was not a nationwide systemic fraud of the kind that would overturn these election results. And that's not what Trump wanted to hear. He also doesn't necessarily think Barr has done enough in terms of investigations into Joe Biden's family, his son Hunter in particular. So there's going to be a month where we're not necessarily sure what Barr was blocking, but there's a month with someone else's attorney general, the acting attorney general. In addition, Barr mentioned in his resignation letter that there were some more things that he wanted to take care of in the next week or so. And so it'll be interesting to see what those things are going forward. But certainly a split with this much time left to run in a presidency, that's not what we would call like routine.
Derek, I know the focus is now firmly on Georgia on the political front, but what can we have on the COVID relief? Are we going to have a bipartisan agreement?
Francine, I'm feeling a little bit better about this than I have been before. You know, I've been a skeptic of a lot of the Wall Street folks who said this is imminent and have been shouting the word imminent for months now, which is not the definition of the word imminent. But what you're seeing now is you're seeing a possible path forward. Indeed, lawmakers are looking at splitting off two of the most contentious issues and proceeding with something around about a little bit lower than what they've been talking about, but still quite a lot of money, and proceeding forward with that, trying to find an agreement. Additionally, I think you should take it as green shoots, the idea that lawmakers are talking about staying in town until something gets done. This week is critical. I would venture to say today is critical, but it does look better now than it has looked at any point in the last, let's say, month or two.
Thank you so much. Our senior editor there, Derek Wallbank, of course, not thinking that the relief was imminent. We could also say the same about Brexit. It's ongoing for now a couple of weeks. Coming up, we talk the prospects of a stimulus in the U.S. and what a Biden administration will mean for trade and the economy. We'll focus on the markets. This is Bloomberg.
it is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, a bipartisan group of U.S. lawmakers is proposing splitting out the most contentious part of a stimulus package. In removing state aid and liability protections, they hope to break months of deadlock over new aid. Now, if endorsed, this could be the first rescue plan to get the support of both houses of Congress since the spring. Joining us this morning to talk about all of this is Gilles Moët, he's chief economist at AXA. Gilles, great to have you on the program, as always. When you look at the stimulus bill in the U.S., so finally we have a president-elect, it's confirmed it's Joe Biden. What are the chances that we get something? It's a much skinnier relief bill than maybe some would have thought, but how urgent is it that we get something?
Well, it's quite urgent because we know that some emergency federal schemes supporting unemployed people are expiring basically now. I mean, within the next 2 weeks. So that's a big difference actually between the US and Europe. In the US, you repeatedly have to come up with a prolongation of the measures, and you have roughly 30 million people under those federal emergency schemes. So in any case, that needs to be done. We need to have some measure of income protection for these people. That's really the emergency. And after that, you have other issues. One, which I think is particularly problematic, is the state of municipal and state finances. As you know, in the US, many states and municipalities have the golden rule. They cannot actually run a deficit. So if their tax receipts fall, the only option for them is to get into fiscal tightening. And there were some calculations by the Brookings Institution, for instance. According to them, we would end up with a net fiscal tightening of 1.5% of GDP in the US next year if states and municipalities do not get support. So it's getting kind of urgent, I would say.
Gilles, given the vaccines, what's the trajectory right now for the world economy and for the U.S. economy? So does the trajectory actually depend for inflation, but also for GDP, depend on that, the relief bill at the margins, or is it something that you actually put to one side?
I think we need to get some measure of additional support, especially again in the US, because of the structure of public finances in the US, just to avoid that we have another contraction in activity in the first quarter of 2021. So that's kind of important. Obviously, the big news of the last 1 or 2 months is the fact that thanks to the vaccine, we can count on exiting the sort of stop-and-go situation in which we've been since February. And depending on the logistical issues that we face, it's something we should be able to see, let's say, from the middle of 2021 onward. So my view for the trajectory of growth is quite simple. It's kind of two-speed or two-halves story. Still complicated, mediocre, I would say, throughout the first half of 2021. Probably, especially if we don't get a significant fiscal push, and obviously a much stronger rebound in the second half of 2021. On inflation, some of the current drop in inflation is purely mechanical. This is due to the drop in oil prices, VAT cuts in Germany, for instance. Some of those one-offs will just disappear. So we should see mechanically inflation rise a little bit in 2021. But the endogenous engines of inflation, in my view, will remain quite subdued. The labor market is in no shape to produce a proper inflationary push in 2021. So I'm quite relaxed, actually, on that front.
Gilles, what happens if you get surprised to the upside, though? I mean, I know you're relaxed about inflation. Is there any chance, could something happen, for example, the recovery or the vaccine, if we achieve a herd immunity quicker than we think, does that change your inflation forecasts?
Obviously, anything is possible. I would be really surprised again, because if you look at the labor market is quite soft, I would say, everywhere. So you don't have the right ingredients for wage growth to really accelerate. But okay, let's assume that something happens. Okay, I think in the case of the Fed, in case of the US, what at least we know is that they would allow some inflation overshooting. They told us so. We are in this average inflation targeting mode, which means that even if we have a positive surprise on inflation in 2021, the quantum of support we would get from the Fed would not necessarily change. The issue might be a bit different for the ECB because they are not, at least not officially, in this average inflation targeting mode. However, they just told us what they were going to do at least until March 2022. So we have a measure of visibility, if you want, on the quantum of policy support we will get from central bank, irrespective of where inflation is.
Gilles, yesterday we had a very important call from Mario Draghi and Raghuram Rajan saying that actually we need to do everything we can to avert a global solvency crisis. How dangerous do you think this could be?
That's going to be, on everyone's mind from 2022 on, because forthcoming we knew that, emergency support schemes that we have in most countries, and thanks to monetary policy support, solvency issues can be being put on the back burner. And actually what we have is this focus on the opposite of solvency issue, which is the zombification story. After 2021, yes, this is going to be a big issue. I think there are several things we can do. One, precisely because we have this solvency issue, I don't think that monetary policy can afford to normalize very quickly anywhere in the world. There's an absolute necessity to maintain some level of debt stability conditions will be one of the reasons where, and again, maybe irrespective of where inflation is, monetary policy will continue to be super accommodative. And I would not be surprised if we started seeing some creative approach on dealing with legacy debt. One possibility, for instance, would be for prolongation of the loans which have been issued during the crisis. That's for private debt, and central banks could be involved in this. And on the public policy side, my guess is that one of the solutions we'll find, maybe a bit complicated, but we'll get there, is to consider that the quantum of public debts which central banks have been forced to buy during the pandemic crisis is not going to be cancelled. That's not going to happen, but it's going to be kept on the central bank's balance sheet for a very, very long period of time.
Gilles, thank you so much. Gilles Moec there from AXA. He stays with us, and we'll come back, of course, to this idea of staying on the balance sheet for a long time. Coming up, Credit Suisse also sees its investment bank actually raking in more money this quarter than the last 3 months of 2019. We'll dig into the details of the Swiss bank's strategy update. That's coming up shortly, and this is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, Credit Suisse says its investment bank continues to perform well, with revenues for the fourth quarter ahead of a year earlier. The bank has confirmed a target for a return on tangible equity of 10 to 12% in the medium term, while it's also planning to restart share buybacks in January. Joining us now from Zurich is Bloomberg's finance reporter, Marion Halftermeyer. Marion, thank you so much for joining us. What are the key takeaways from the update this morning?
Hi, Francine. Yeah, so what we're looking at here is three main takeaways. As you mentioned, the return on tangible equity target of 10% to 12%, a share buybacks of 1.5 billion Swiss francs starting in January 2021, and then they've also increased the profit target for the wealth management division. Key to think about when you're looking at the return on tangible equity target is that they have hedged that this may be difficult to achieve next year, as we just don't know what credit loss provisions will look like as the pandemic continues into the next year.
So what have they actually said about the fourth quarter performance guidance?
Yeah, so fourth quarter is going to be, it looks like it'll be much like the third quarter, so a lot on transactional revenues, both from the wealth clients doing a lot of trading, particularly in Asia, and then also the investment bank. They've guided that the investment bank is doing better than the fourth quarter of the previous year, so 2019. But then again, we do need to look at how exactly that's going to pan out, because in the third quarter, they sort of trailed peers on the trading side. So it remains to be seen. You know, they've had a couple of their other peers, Deutsche Bank, who have been guiding that they've been doing really well. So we'll have to see how they duke it out. The other thing about the fourth quarter is that they have a couple hits that will factor into the revenues there. There's a write down on a hedge fund stake they have, and also a provision for a litigation in the U.S.
Marion, when you look at some of the risk and compliance at the bank, how's it going?
Yeah, so they've been doing an ongoing restructuring of the risk and compliance units that was announced at the half-year mark. But this has been a really difficult year for them. They've had a lot of things been exposed through the pandemic. They've had different funds who aren't working. There's a couple of scandals that, you know, there's this famous Black and Coffee case in Asia. They've been involved in some difficult situations with SoftBank. So it's not been an easy year. And I think a lot of what Thomas Gottstein, the CEO, has been doing this year is trying to figure out what's going on, clean those individual instances up, and then set themselves on a better path for next year.
Thank you so much, Bloomberg finance reporter there, Marion Halftermeyer. Now, coming up, with London being moved into the UK's toughest tier of virus measures, Germany, Italy and the Netherlands all increasing restrictions. We'll discuss what that means for Europe's economic recovery. We're delighted to be joined by Gilles Moek next. We'll also talk about Brexit and what exactly that means for the economy. Overall, the markets, if we have them, let's bring them up to show you exactly what investment feels like. Now, the focus is on extra restrictions. The focus is on the virus. Also, Michel Barnier saying there's a deal that could be done. So we'll exactly see what that means. Treasury is a little changed. Oil actually dropping from a 9-month high. We'll have plenty more market checks throughout the hour. This is Bloomberg. another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Joe Biden is now officially the president-elect after the Electoral College confirmed his victory. It puts him over the 270 votes needed to win, and he'll be inaugurated as the 46th president on January the 20th. Speaking after the vote, Biden noted his 306 electoral votes is exactly the same number President Trump earned back in 2016. And U.S. Attorney General William Barr is stepping down. That's after publicly disagreeing with President Trump's claims of widespread voter fraud at the 2020 election. Trump confirmed the move on Twitter, saying Barr has done an outstanding job. He'll be succeeded on an acting basis by Deputy Attorney General Jeff Rosen. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, London and parts of southeast England are heading into Tier 3 restrictions from Wednesday. That's as UK authorities warn of a new variant of the disease that could be driving a rapid rise in cases. Meanwhile, New York is heading towards a second full shutdown if cases and hospitalizations continue at their current pace. That's according to Governor Andrew Cuomo. Well, still with us is Gilles Moek from AXA. Gilles, there are a number of things I need to ask you when it comes to Europe, including the Recovery Fund and Brexit and everything in between. But let's maybe start with the European Central Bank. If there was about an inflation in Europe, and I know you're not expecting it worldwide, but if there was something in Europe, could the ECB even afford to increase interest rates given where we are on debt levels?
No, I don't think this is within the realm of possibility at the moment. Obviously, technically, price stability is the ECB's only compact. In truth, in reality, and given the emergency situation in which we are, for the time being, it's quite clear that the ECB's priority is on making fiscal policy possible by making sure that financial conditions remain favorable. So my absolute belief is that in 2021, it's going to be more complicated later, but in 2021, again, if there was any chance of an inflation rebound, the ECB would look through it and would probably consider that given the cyclical gyrations in the economy, it would be very hard to know if any inflation hump is temporary or if it's just a fluke. So for 21, I really don't think it would be on the cards that they would engage in any kind of monetary tightening. Again, it would be more complicated once the pandemic emergency is over, once PEP is over, which we know is not going to happen before March 2022. But from then on, yes, obviously, if there's an inflation surprise, then the ECB would have to deal with a conflict of objectives. But I would say that a bit by definition, if we end up with stronger than expected inflation in Europe, it will mean probably that our economy is doing better than we thought. It would mean that firms' pricing power is stronger than we thought, which means also by definition that our economies could cope better with a normalization of monetary policy. But that's for 2022.
Gilles, what are the prospects for Euro right now? So we finally have a recovery fund. We're not exactly sure where Brexit is headed, but it's maybe a bit more positive, certainly, than it felt like last Friday. Does Europe outperform the rest of parts of the economy, or is it still in dire trouble?
No, I think the problem Europe has to deal with in the very short term is the fact that the second pandemic wave is less, how to say, the peak is lower than what we had during the first wave, but it seems to be quite stubborn. The second wave is quite resilient, which is forcing some restrictive measures probably longer than we initially thought. We've seen, for instance, Germany preparing to announce a toughening up of the restrictive measures probably into next year. France has also prolonged some of the restrictive measures into January. So it's a shallower type of mobility restriction, but it's likely to be quite long. So fourth funding, unfortunately, I would say that GDP in Q4 probably is contracting, and the rebound in Q1 is likely to be quite mediocre. But what is positive is that on economic policy, I think we have our house in order. Finally, we managed to cut a deal with Hungary and Poland to make the Recovery and Resilience Fund possible. The money is not going to be disbursed immediately, but I think politically it's a very strong message about the solidity of the Eurozone. And we have an ECB which has gone a bit further than what the market was expecting. So policy support is quite robust at this stage, I would say.
What do you make of Brexit? So there's a skinny deal on the table. Even if we don't get that, is it a domestic UK problem, or can it spill over to Europe?
Well, given the situation in which we are with the pandemic, I would say that the ramifications for Europe would be kind of drowned into the pandemic noise. In normal circumstances, yes, you can probably the kind of figures we would have in mind under a no-deal scenario, the impact on euro area GDP could be somewhere around 0.4, 0.5% over 21. In normal circumstances, that would be a lot. But given the kind of gyrations in which we've been living since February of last year, it feels like a drop in an ocean. For the UK, obviously, the impact would be higher. So I think that's one of the reasons actually why Europe is quite relaxed in its approach to a no-deal Brexit at the moment. Not that they would wish it. It's simply that honestly, on the list of issues they have to deal with right now, it probably doesn't rank very, very high.
But does it mean that European companies that actually export to the UK have all the necessary paperwork? Is there anything that actually could happen, Gilles, that could be a big hit for German exporters, for Italian exporters?
No, it's not. It's bad news. Look, there's no way around it. And I would say even if we have a deal within the next few days, it would still be a very mediocre deal. And it's actually very likely that we'll have logistical issues crossing the border between the EU and the UK on January 1st, even if we have a deal. So it's not good news. If we don't have a deal, then we'll have tariffs on top of everything else, and probably even end up logistical issues. So yes, it would be problematic for German, French, Italian producers. That's why you could end up with an impact on the euro area GDP of roughly 0.5 point, which again in normal circumstances would be high. But it's likely to be drowned into the shock of the pandemic. Everyone wants a deal. Everyone wants a deal. It's in everyone's interest. It's just that the balance of pain, if you want, between the two parties, for me, is quite different. If the UK doesn't cut a deal on the 1st of January, they will lift tariffs on products coming from the EU. That will trigger an inflationary shock in the UK. And that would come on top of all the logistical issues. So there is no doubt in my mind that the impact on the UK would be quite significant, much more significant than the impact on the euro area as a whole.
Gilles, when going back to the ECB quickly, does it matter if controlling the yield curve, if they're a yield curve controller or not? Or actually, are they, even if they say they're not?
Well, they are. Because if you say that the purpose of your action at the moment during this emergency is to preserve financial conditions and making sure that financial conditions are favorable enough to allow fiscal support to happen. In reality, you are in yield control. The only difference with what the Bank of Japan is doing, for instance, is that it's not explicit and there is no quantitative threshold. They're not saying we are trying to keep interest rates more or less, at this level. But there was a bit of, I don't know if it was a slip of the tongue or if it was voluntary from Christine Lagarde, but she said, keeping interest rates unchanged, which is basically telling you that they would try to keep yields broadly where they are right now. And I guess that where they are means for German yields, but also for peripheral yields. So we are in implicit yield control. It's probably the right approach at the moment because the normal channels of monetary policy probably don't work at this juncture. You can cut interest rates as much as you want once you're in negative territory. The impact you have on the private sector is smaller and smaller. But what you can still do is making sure that fiscal support can be powerful, and you can do this by dealing with any concern the market would have on debt sustainability, at least for this year. Yeah. That's what the ECB is doing. It's probably the most efficient use of their framework, I would say.
Fabulous. Thank you so much, Gilles Moec, there, Chief Economist at AXA, with some great insight and analysis. Now, coming up with the Brexit risks and in the wake of the COVID crisis, how will London's property market actually fare in 2021? We'll discuss that next, and this is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the UK is living through the biggest housing rally in almost half a decade. There's also a segment of the market that is lagging behind, though, and that's London's luxury properties. House prices in the city's most expensive areas slipped 0.1% between June and November. While the national growth has been fueled by tax breaks, London's prime real estate is also suffering from a lack of international buyers. So let's talk about this with Nicolò Barattieri. He's the chief executive of Northacre, and through the years has given us some wise insight into that part of the retail market, the real estate market. Nicolò, thank you so much for joining us. When you look at the state of the market right now, when are you expecting international buyers to be back?
Well, it's interesting because even though viewings obviously are down, we're seeing that volumes are back to pre-pandemic levels, right? And so if in January you would have told me that we would have had a world pandemic and you would have told me that people wouldn't be able to travel and would be sitting at home since March, I would have predicted a cataclysmic outcome. But that hasn't been the case. People have adapted in looking on how to buy properties also remotely, and there has been a much greater focus on the home than there was before. So it's quite interesting that, as you say, central London is basically flat, whilst in general London as a whole is up about 4%. But that can be said for many cities around the world, from LA to Tokyo to many other places. So it's interesting that homes in general have fared very, very well in this environment.
Nicola, overall, when you look at the prospect of a possible capital gains tax in the UK next year, what impact would that have on the luxury property market?
Look, I think that, everything that possibly could have been thrown to the property market has been thrown since 2014, right? The change to non-dom rules, 2 different hikes in stamp duty, one other one coming in for foreigners in just a few months, Brexit. So this would be one more thing that obviously would keep the market subdued. And that's why we have been in a flat to bear market now for 78 months, right? This is as long as a bear market as anyone can remember. People always talk about the one in the early 90s, late 80s, early 90s. That was 36 months, right? This is double the length. It's already quite protracted. And that's why we're seeing that in the market there's a pent-up demand, right? There's only so much you want to delay purchasing your home. And 78 months starts being quite a long period of time.
Our bureau chief is writing in, Nicola, and he's, obviously watching what you're saying, and he reminded me that Molior says that Zone 1 new home sales are on track to be the lowest ever. Is there, a trend of people moving to the countryside because of COVID? Do people want to be, elsewhere than in the capital, and certainly elsewhere than Zone 1?
There's a lot of talk that people are going to be migrating to the countryside, and it's the end of urbanization. I remind people as well that the same thing was said when the telephone was invented in 1876. That when it was invented, everyone was saying, now because people can now talk remotely, they will move away. Exactly the opposite happened. So I think that we're going to be talking about it in the next 2 or 3 years, and we're going to see that actually it's not the end of a trend that is, decades and decades long, and urbanization is here to stay, and that maybe, people are more important than trees in our livelihood, and so I don't see that happening in the long term.
So how challenging would you say London has been as a market for overseas developers in the last couple of years?
I think for developers in general, it has been a very challenging market. When you have a market that doesn't rise for a period of 6 years, it's very challenging. And obviously there is additional stock on the market that would have been usually absorbed. As you said, transactions are at a low point in this year. However, one has to see that in prime central London, when you look at high-end transactions, the difference between a bear market like what we've been in to a bull market is about 300 different more transactions. It's not a humongous amount. So it's very quick to turn around. And we've seen that during periods of distress like you've had in 2009. But also, as you're seeing now here, London is incredibly resilient, and it's a place where people really want to come. So they take the opportunity. They take the opportunity that you've got a weak sterling. And this has fueled some of the stability in the market in the last year, much greater than I would have thought.
Yeah, we've talked about COVID and we've talked about a number of things, but we haven't talked really about Brexit. Maybe another question, and then I'll ask you about what you're expecting for the next 3 to 4 months. We've seen a huge uptick in Hong Kongers asking for British passports. Does that translate into home sales?
Yes, this will be translating into home sales. So you have to see where those are focusing in the market. At the moment, they're focusing to the lower end, to the mid-market point of the market. So they're looking in different cities in the UK, not necessarily just London. But I feel that then there is going to be the tail end of that will also be looking at prime central London as well. So definitely there's pent-up demand that is coming from that region of the world, and not just Hong Kong, but in Asia in general.
Okay, so we have Brexit, we have COVID, we have possible capital gains tax next year. How do you see the luxury property market developing in the next 6 months, 12 months, and then 18 months?
I think that in the short term, the difficulties that we're experiencing now will be prevailing, right? So travel restrictions are obviously a big negative for this market. We need people to come and see the properties in order to buy them, in order to increase that number that you talked about before. And in general, the weak economy as well will probably be prevailing in the next 3 to 6 months. Now, having said that, we are going to be in a backdrop of zero interest rates, and I believe that these zero interest rates are here to stay for some time, right? Governments can't afford to increase them due to the debt levels that they've incurred. I think that international buyers' love for London is still very, very strong. And again, the weak sterling really will help the market. So what you've seen in this last year, which has been incredibly difficult, is that actually volumes haven't dropped off a cliff. And if you just start having a little uptick in volumes, that's a precursor for prices to go up. So my prediction is difficult in the short term, but on my 18-month view, I think that this is your buying opportunity, right? Last year and the first 6 months of this year coming.
Nicola, if you look at next spring, there's a convergence of things, and you said the end of the stamp duty haven and a couple of other things, including stamp duty haven from overseas. Are you expecting more government stimulus to counter that, kind of in spring of next year? And what shape would you tell the government that stimulus needs to take?
Well, I think they've got to continue championing the UK as a brand, right? Which probably hasn't been done as effectively as they should have done in the last 6 months, because obviously they've been preoccupied with many other things. But in general, residential assets, like many assets in the world, are forward pricing mechanisms, right? So I think that the bad news that has come, is in the market, right? Prices in prime central London are down about 20% in sterling terms since June 2014, and if you put that in dollar terms, we're talking closer to 40. So it's been a substantial move, which I think prices in a lot of this bad news.
Nicola, thank you so much for joining us. Nicola Baratieri there, the Chief Executive of Northacre there on luxury property. Coming up, a chaotic year ahead. That's according to the Airbus Chief Executive, Guillaume Faury. We'll have more from our interview with him next. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate
it is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
I think it's going to be very complex to move from today to a normalized situation, probably end of 2021, 2022, and 2021 will be chaotic, most probably.
Well, that was the Airbus chief executive, Guillaume Faury, talking about the year ahead. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Credit Suisse says its investment bank is continuing to perform well, with revenue higher than in the fourth quarter of last year. The Swiss bank is restarting its share buyback program in January and sees a significant turnaround in asset management in 2021. Airbus is warning that no post-Brexit trade deal puts its investment in the UK at risk. Chief Executive Guillaume Faury says decisions will be made based on how easy it is to conduct business after the split. In the meantime, the company has no plans to close or scale down its British operations. And tech giants could face fines of up to 10% of revenue if they fail to comply with EU rules. According to a draft seen by Bloomberg, the companies will be banned from using any data from business users to compete with them. A company that systematically breaks the rules could be ordered to divest businesses. And government agencies and major corporations outside the US are reviewing their computer systems for signs of security breaches. That's after a hacking campaign inserted malware in software updates from company SolarWinds. It has more than 300,000 customers worldwide, including the UK's National Health Service and NATO. Now, London is being hit by the UK's toughest restrictions. Now, that's from tomorrow, and authorities are warning a new variant of coronavirus may be driving a rapid rise in cases. The switch to Tier 3 means pubs and restaurants will close, except for serving takeaways. Health Secretary Matt Hancock says the new measures are essential to protect lives and jobs in the longer term. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. The market's firmly focused on exactly how many number of new infected there are and also on these restrictions of lockdowns. We had an interesting take from Jean Moek from AXA, who was basically saying, of course, the good thing about the vaccine is then we're going to see a recovery and we won't be in this start and stop kind of scenario. Overall, the picture is U.S. futures signaling a rebound. I'm looking at trading, pretty much mixed. European equities holding, but not to massive gains. There are lingering worries about tougher lockdowns. Treasury is a little changed. Oil dropping. Bloomberg surveillance continues. another day of risk off across the financial markets, we bring you special coverage of all the price action and implications here on Bloomberg Television. It's official. The Electoral College confirms Joe Biden's victory. He asks Americans to look ahead to the urgent work of getting the pandemic under control. Curbing the virus, new restrictions threaten major economies. London is set to enter Tier 3 rules. New York could see another full lockdown. And Credit Suisse will restart share buybacks in January. It also says fourth quarter investment bank revenues are ahead of the previous year. Well, good morning, everyone, and welcome to Bloomberg Surveillance. Tom Keene, welcome back. I'm Francine with Tom in London and New York. Now, a lot of the focus is on Tom's bow tie. A lot of the focus is actually on Brexit. Tom taking a couple of days off just so he didn't have to look at volatility in pound. We look at Joe Biden, finally president-elect. It's confirmed. And, of course, the focus is on the stimulus, whether we get it or not, Tom.
There's a lot going on here. I would say the virus overwhelms everything, Francine, even Brexit, the story in London, and certainly different stories in the U.S., a Fed meeting coming up as well. But everything said and done, the virus has taken a new leap of new attention. Certainly in New York City, that's the case.
Yeah, and London, we're definitely in Tier 3, and that starts tonight. It's interesting, Tom, to see actually how quickly and how damaging to the economy it is, the stop and start. The fact that restaurants still have quite a lot of things that they've bought and they suddenly have to lock down, and a lot of restaurateurs here saying that actually it'd be just better staying in lockdown, some kind of lockdown, so that it's easier for planning.
Well, certainly it changed New York City as well as the restaurants shut down. Mayor de Blasio yesterday, folks, for those of you across the country, really pretty grim about the tough decisions he and the governor of the New York State have to make, Mario Cuomo. I had to take a day off, Francine, just to prepare for your birthday. I mean, I went into intense. I had my birthday, and Francine's is worse than mine, folks, because it's closer to Christmas, where everyone around here could care less about her birthday because Christmas is right there. I mean, that's the reality, right?
This is Tom, the reality of having children is if you're born December 15th, it's suddenly the home stretch to Christmas.
Exactly.
My mother's making homemade lasagna with pesto, and that is really everything you need. The only thing you really need for a homemade birthday. So thank you, Tom. Thank you, Tom, and the team.
I did not get homemade lasagna with pesto for my birthday.
Next year.
Either did Leanne Gerrans with our first word news in London. Leanne Gerrans.
Good morning, Tom. President-elect Joe Biden says it is time to turn the page on what he called an unprecedented assault on democracy. Biden spoke hours after the Electoral College sealed his win. He noted that he won 306 Electoral College votes, the same as President Trump did back in 2016.
President Trump called the Electoral College tally a landslide. By his own standards, these numbers represented a clear victory then, and I respectfully suggest they do so now.
President Trump offered no public reaction to the Electoral College vote. Now, a grim milestone in the U.S. battle against the coronavirus. The death toll has now gone past 300,000. Meanwhile, more than 600 hospitals across the country are receiving vaccines this week. The first shots are being given to healthcare workers. President Trump praised outgoing Attorney General William Barr for having done a, quote, outstanding job. Still, Barr is leaving office later this month after having crossed the president on two key issues, his claims of voter fraud and the investigation into Joe Biden's son. The president criticized Barr in an interview last weekend. Global news 24 hours a day on air and a Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine, Tom.
Well, Leanne, thanks so much. Let's do a data check now. Equities, bonds, currencies, commodities. And the trap here, folks, is to go into like a zombie state because there's not that much going on. Yet, there is. It's really interesting to look at the correlations and non-correlations out there. We'll wait to see what the VIX does with a level of 23.41, futures up 23. You know, it's all within a range. We're just under 30,000 on the Dow futures. I want to point out the two-year yield to four digits, 0.1170. It was actually a bit lower. It is sitting 3 days in a row on a new lower bound of the lower 2-year. And that really gets my attention with a real yield that's unch, but nevertheless a solid negative stick is what we call that at 1.000000. That's as good as I can do. And now, folks, a birthday data check with Francine Lacroix.
Yeah, birthday treasuries, a little changed. Oil is actually dropping from a 9-month high. If you look at, European stocks are really mirroring what's happening in U.S. futures, which they are seeing a bit of a rebound after the slide yesterday. But overall, trading is pretty much mixed, Tom, and they're looking at lingering worries about tougher lockdowns, and they look at exactly what less travel because of more restrictions means for the travel industry. And so you can see also oil dropping from a 9-month high on that concern. Now, Joe Biden, officially the president-elect after the Electoral College confirmed his victory yesterday. It puts him over the 270 votes needed to win, and he will be inaugurated as the 46th president on January 20th. Joining us now is Leslie Vinjamuri, Chatham House head of U.S. and America's program. Leslie, thank you so much for coming on. We have like a million questions for you. But first, is it now a done deal? Does President Trump move on?
It is legally a done deal. Of course, there are a few more hurdles, even on January 6th. But it is a done deal. I think the real turning point in many ways was that Supreme Court decision not to pursue the case. But remember that the real problem for President-elect Biden, he's now officially President-elect Biden, is that he's facing a divided country. He's facing a House where House Republicans have really not supported him. A majority of them supported and backed that Texas-led Supreme Court case to undo the results in those 4 battleground states. So he's also facing Republican electorate where 77% of Republican voters think that there's been fraud in the election. So the division, across the public in Congress is going to be challenging after January 20th when he looks set to govern. And we're seeing some of that play out again and again in the debate over fiscal stimulus, which we know is absolutely critical at a time when so many Americans need those unemployment checks. But those big sticking points on aid to states and on liability for COVID for businesses, schools, and other organizations, those are big sticking points for Republicans and Democrats not agreeing. And we're seeing the challenges of governing in a deeply polarized, deeply partisan Congress.
Lizzie, I know we want to talk about stimulus, but actually how significant is it that, the Attorney General stepped down, 1 month and 5 days before the new president becomes in charge?
Well, it's significant. I mean, I think, at the end of the day, President Trump has shown us time and time again that when that loyalty is gone, and remember, Attorney General Barr was as loyal as they came in his inner circle. When that loyalty is gone, what's at stake for the country simply is no longer the primary consideration. But having that seat vacant is not a good thing. We saw that in the Defense Department as well. I mean, the transition process continues to be fraught. But the big story, as Tom said earlier, is the pandemic over everything else. And, the good news is a vaccination, but there's a lot of work to be done.
Leslie, good morning from New York. I got like 8 ways to go here, Leslie, but in the time that we've got, I want to harken back to the warfare I read in Alan Nevin's a million years ago on the 1880s and the 1890s. We seem to be back there where the polarization of Congress is truly embedded. Does the Biden administration have a honeymoon, or is that just gone in this day and age?
Tom, you know what I think. I think there's no honeymoon, and it's not only because of the deep polarization across the United States and the partisanship in Senate and in the House. It's also because Joe Biden will enter and take lead of a country where well over 300,000 Americans will have died, and where the numbers will be continuing to accelerate, and the need for economic recovery will be acute. Now, those conditions sometimes lead people to rally and to forge compromises and to move forward, but that is not what we're seeing right now. We are not seeing any signs that Mitch McConnell, if he remains a Senate leader, depending, of course, on the results of those two races in Georgia on January 5th, if Mitch McConnell remains in position, it does not look like we're going to see that kind of compromise emerge, despite the very strong personal relationship historically between Biden and McConnell. So a fraught period. It's not like what we've seen in the past.
Explain to us your estimation and Chatham House's estimation of a glide path, and I'll have a chart on this later. We hope to get it up, folks. It's a fancy log chart of the deaths in America, where 400,000 deaths is a cup of coffee away, and 600,000 deaths, is modeled by our wonderful Steve Dennis, is the 4th of July. I mean, that kind of pressure, will that affect our Congress, or are they immune to that like they're immune to doing stimulus?
You know, the problem, Tom, as we know, is that those deaths are highly distributed. This is not a pandemic that's having equal effects. The infection rate is extremely high, but the death rate is distributed. The rates are higher amongst minorities, amongst low-income groups, and they're not affecting every seated elected official the same in terms of their political calculations. And there's also still a very deep divide in the electorate between those who just simply think the vaccination is there, we should move forward, open up the economy quickly and get going, and that's a real risk. And obviously, the economic costs are high. And those who think we need to have much tougher policies. So the divisions are in the American electorate, they're in Congress, and it seems to be impervious to the rising number of deaths, that deep division.
Leslie, how does President Biden, when he comes into power, actually try and bridge that divide?
Well, I think, the first thing, apart from the international agenda, which will be serious, but I think that we are going to see a president who really works the domestic policy agenda at the state level, at the local level. He's put people in the White House, who would have been in foreign policy positions, people like Susan Rice, who's a woman of color, obviously, to really focus on the domestic agenda. I think he's going to do his best to work Congress to get more fiscal stimulus quickly. But, one key thing here is that the Republican Party, right, holds a lot of the cards, will probably continue to hold a lot of the cards in the Senate. And we do not know how their calculations will change once President Trump is out of office. Surely he will continue to mobilize support, to rally, and to keep a hard core of the Republican Party that are completely committed to him. But things will change. The space will open up as he leaves. That will change the dynamics in the Senate amongst the Republicans. And the need, I think, as there is more hope with the vaccination, the need to forge compromise, I think that's going to play a bit to Biden's favor. But it's going to be very challenging work. A couple of good places for him to hit wins. One is on infrastructure investment. There's widespread bipartisan support. I think that will go well. But of course, these are, second order in light of the grave circumstances right now and the need for fiscal stimulus and vaccination distribution. I think on some of that, especially on the vaccine, we will be able to get a consensus.
Leslie, I look finally at this, and I'm sort of speechless, folks, because we got to try to get through Tuesday and on to Wednesday, and hanging over all this is pardons. I did a search today of the legal backdrop of pardons, and I was shocked at how little information I found on the legality of it. Is the pardon process of any given president, and this president, is it a mystery?
I think the pardon process, you know, it was historically there for a reason. Reconciliation is important, protecting people from partisan politics, especially when you're transitioning from a president of one party to one of another. You know, there are strong reasons for the pardon, but it's become subject to partisan considerations and very politicized in the current context. So yeah, there are a number of days left in this presidency, and there are any number of things that could happen that are worrying. The use of the pardon is certainly one that we'll watch, but the president cannot pardon himself from state cases, and I think that's something the president probably is quite concerned about.
Again, that distinction of state cases versus federal cases. Leslie Vinjamuri, thank you so much from Chatham House. What a disjointed interview, and that there's like 8 ways to go here just with the news on Washington. I believe Mr. Cirilli is scheduled to be with us later on this morning. Coming up as well, futures up 21, Dow futures up 160. Peter Shafrick of RBC, their global macro strategist, the larger view on the degrees of freedom of central banks. Fed Day on Wednesday. This is Bloomberg. Stay with us.
Some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy. Everyone, Bloomberg Surveillance, thank you for being with us from London, from New York. It's an extraordinary moment. I've said that 8 times this year, but I can tell you, folks, right now, with the virus tendencies that I read on our wonderful COVID update at Bloomberg News today, it's really a different memo today, and really, really serious about cases, hospitalizations, and deaths. Right now, we recalibrate on the international economy. Peter Shafrick with us, RBC Capital Markets, their global macro strategist. Peter, how does the virus and the trend of the virus right now, buttressed up against the good news of a vaccine, how does that adjust or adapt your call for 2021? Well, look, I think our call, and frankly, most people's call, was always predicated on a very, very rough winter. And I think we're now in the middle of it. And, you know, it's one thing if you're sitting in autumn and you're predicting a grim winter, and then when you're in the middle of it and you're actually seeing the case numbers rising, the hospitalizations numbers rising. So, but this was not, unfortunately, this was not unexpected. You could see it coming from miles. So unfortunately, now we have to go through this. As far as the market is concerned, the market had already implied that and is looking forward. And the forward look, luckily,
looks much, much better. So, and I think that's also embedded in our forecast. So we expect a fairly decent recovery coming out of this come Q2 next year.
Okay, well, a decent recovery as well. What do central banks do? Do they need to, clearly fiscal's not happening. Do central banks have to step it up ever more, even if we get to some kind of turnaround mid-year?
Well, I think we have to be careful which jurisdiction we're talking about, because if we're staying in Europe for a second, I think very clearly fiscal is coming, and in fact, it's coming with quite a force. Particularly on the continent of Europe, but also here in the UK. In the US, we'll have to see. We'll have to see what the current negotiations, if they bring anything, if they bring what they bring, and then we'll see what once the next president is in power, what comes thereafter. But clearly, I think the central banks, they have already delivered quite a lot, and I reckon with the latest iterations that we have, they're going to sit there for the next 6 months at least and seeing how that pans out.
Are we going to see inflation after 6 months, Peter?
I think that's rather unlikely. We can talk about a little bit of technical inflation once the VAT cuts come out, but sort of that's not real inflation. I think 6 months is way too short a time frame.
When do we start worrying about debt? Is it something for 2022? And what happens if investors start challenging some of the debt levels as soon as mid-2021?
So first of all, I think we also here have to be a little bit more nuanced, because when we look at household debts, for instance, they're not necessarily all that troublesome. So that's not the issue. Corporate debt is a different story. And obviously, corporate debt is one part of the flip side of corporate debt is investments. So if you have relatively high corporate debt levels, that means corporates will unlikely make the same kind of investments as they otherwise would. And then we've got government debt. And here I'm not that worried about, and I don't think investors will be worried about, as long as the central banks are there and buying parts of it. So I think the real question in my mind is, how can we get corporate America, corporate Europe to invest in an environment where debt levels are already relatively high? And this is again where we come back to fiscal and what the fiscal can do, maybe in PPP partnerships or something like that.
Tom, you there?
Okay, Peter,
I think we've lost.
Okay, we're going to come back. We got a little technical difficulties there, folks. We'll come back with Peter Shafrick of RBC Capital Markets. Stay with us. Clear signal with Peter Orszag of Lazard. Looking forward to that in the 6 o'clock hour. Futures up 21, Dow futures up 157. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen
And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This is Bloomberg Surveillance. I'm Leanne Gerrans with this Bloomberg Business Flash. The Federal Trade Commission has ordered some of the biggest tech companies to hand over information on how they collect and use customer data. 9 companies were mentioned, including Amazon, Facebook, and YouTube. The FTC is also asking about the company's advertising and user engagement practices and how these affect children and teens. Credit Suisse has signaled that business is continuing a mixed performance in the fourth quarter. The investment bank is doing well, with revenue higher than it was a year ago. But Credit Suisse warns that write-downs and legal provisions will weigh on earnings. And that's your Bloomberg Business Flash. Francine, Tom?
Leanne, thank you so much. Now, U.S. futures signaling a rebound after what we saw over the last couple of days. Same here, actually, here in Europe. If you look at the European Stock 600, they're looking at lockdowns, extra lockdowns, certainly Tier 3 in London and elsewhere in the UK, and they're looking at Germany. Investors focusing on the vaccine rollout, but trading is quite a little bit mixed. Again, the dollar and the pound both steady for the moment, but we could have quite a lot of news when it comes to Brexit shortly. And while investors are pricing in optimism about the start of the vaccine shots, there's also ongoing concern about whether a stimulus bill from a bipartisan group of lawmakers in the U.S. will actually gain traction. The virus, as Tom said, continuing to rage in the U.S. That threatens harsher restrictions across the nation. We did hear from New York City Mayor Bill de Blasio warning that people should be prepared for a full shutdown. European governments, I mentioned London, I mentioned the Southeast England, but also Germany and others also tightening measures. What else I'm looking at is, of course, the price of oil. This is because there are worries out there that extra restrictions mean extra travel restrictions, and therefore the price of oil dropping from a 9-month high. Coming up, we track the virus with Dr. Amish Adalja from Johns Hopkins. This is Bloomberg.
Well, the main instruments on board include a dual frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise, but also the waves. The significant wave height, which is the top 1/3 of the waves, if you were to look at them in time.
Sea level rise is accelerating, and it is not geographically uniform. In some regions, the rate of rise is 2 to 3 times faster than the global mean. This means that in this region, the elevation since the beginning of the 90s is now nearly 30 centimeters, which is not negligible.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I know that this is difficult news, and I know that it will mean plans disrupted, and that for businesses affected, it will be a significant blow. But this action is absolutely essential.
If we don't change the trajectory, we're going to go to shutdown, and then your business is going to close.
Het coronavirus grijpt nog sneller om zich heen.
The coronavirus is spreading even faster than we predicted last week. That is why the Netherlands will be going into lockdown for at least 5 weeks.
There is no such legislation, such as a fine or penalty, so the only thing we could do is to ask people to cooperate. Under such a circumstance, Tokyo residents have been cooperating with us.
I just want to say that if we have too many contacts now before Christmas, then it's our last Christmas with our grandparents. Then we will have been negligent. We should not do that, ladies and gentlemen.
It is grim news. There is no other way to put it. These are leaders from around the world dealing with what we've all dealt with in the last 24 hours. We each have our individual stories. Francine Lacroix and Tom King with Peter Shafrick of RBC Capital Markets. Peter, I want to go to the elephant in the room, which is the amount of income substitution and income replacement that will be required. I know there's a vaccine. I've got a chart coming up which is frightening on this natural disaster. I want to go to the liberal economist Claudia Sahm of Washington, who says all these suits and ties are out of their minds. We're looking at multiple trillions of dollars of income replacement. Are we way off the mark in our calculation of the stimulus necessary?
Well, I think we have to differentiate, if you ask me, between stimulus on the one hand and bridge on the other. And I think what we're talking about when we specifically talk about the income substitutions in the here and now, and we keep in mind these are mandated shutdowns for very good reasons, but mandated shutdowns. So it's not that somebody voluntarily says, oh, I don't want to work anymore. And in my mind, from a moral point of view, substituting some of the income, helping these people to get over the bridge, that's absolutely necessary. Now, it is also necessary from an economic point of view, because otherwise what could well happen is that otherwise viable businesses will go under and can't come out of this, even if they're allowed to operate again in a normal environment. Now, that's one thing. And stimulus going forward, that's quite another. When we talk about coming out of this, we know that there's going to be scarring, businesses have been closed for good and all these type of things. And we also know that we had a bunch of problems that were already there before that. So the question then is, how do you stimulate the economy in an environment that we're in with ultra low interest rates and all the rest of it, in a way that we can actually regrow once the pandemic actually is over? And these are two very separate things in my mind.
Peter Shafrick, the labor economics of Michael Fagan is something. He was sitting at the end of the Queen's bed in The Crown. This is the intruder years and years ago who broke into Buckingham Palace, not once but twice. And he said to the Queen, there's just no jobs out there. I'm paraphrasing, folks. Peter Shafrick, is that where we are right now, where there's just no jobs out there?
Well, it's not. Again, this is not entirely true. When you look at the part of the economy that remains operational, there are jobs out there. And in fact, when you see once we reopened the economy over the summer, how quickly employment did come back. Now that's one part. However, there is one element where jobs will be destroyed, where they won't be able to come back. So there is going to be, in my mind, a higher residual unemployment on the other end of this tunnel. And we have to work afterwards. What are we going to do with either these type of jobs? Can we revive them, or can we rejig the economy in a way so that the people who were working in those areas that are now no longer viable can find jobs again? But that's different from the part that has been mandatory shut down but is viable once we cease to shut them down.
So, okay, but Peter, taking both of those into account, how much disruption will we see on the jobs, front? So we keep on hearing that the new economy, which will be based on climate change, certainly in Europe, will create jobs. How much disruption will we need to actually retrain people to to be in those jobs?
Well, to be honest, the answer I can't give you a priori. Our estimates about where unemployment levels currently would sit, if you take all the substitution into account, is certainly quite significant. I mean, in the UK, it could easily be as high as 8, 9, maybe even 10%. On the continent of Europe, it could also be in those ballparks. And then the question is, how quickly can you reduce that coming out of it? We reckon that we'll easily end up with 2 to 3% unemployment that has not been there before, that has to be worked through. And that takes time. It takes easily, a year, I would say, maybe even more.
Thank you so much, Peter Schaffrichter, RBC Capital Markets, a global macro strategist. Now let's get straight to the Bloomberg First Word News. Here in London is Leanne Gerrans. Hi, Leanne.
Hi, Francine. Joe Biden is calling on the American people to accept the outcome of the presidential election. Hours after the Electoral College sealed his victory, Biden called on the country to, quote, turn the page on what he called an unprecedented assault on democracy. President Trump has no public reaction to the vote. It turns out more U.S. agencies were targeted by Russian hackers. The Department of Homeland Security was hit, and the New York Times says so were parts of the Defense Department. Meanwhile, the Washington Post says that the State Department and the National Institutes of Health were also hacked. Federal agencies have been told to disconnect their SolarWinds software that the Russians manipulated to break into networks. In China, the economic recovery is picking up steam. Industrial output was up 7% and retail sales grew 5%. Chinese economy is likely to be the only major one to expand this year. It's been boosted by strong demand by both home and abroad. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine, Tom.
Leanne, thanks so much. One of the great aspirations, if you are at the Lycée Français Charles de Gaulle, is someday I'm going to quote the U.S. 10-year tips. That is what happened to Francine Lacroix. She got a fancy education, and it was downhill from there over a storied 8-year career at Bloomberg. She's on speaking terms with Steve Schwartzman, but not with me. And, of course, what's important here, there's some other. Matt Miller. Yes, Matt Miller is on speaking terms with Francine as well as the gentleman from Airbus. And her entourage.
My entourage.
Her entourage is double the size of John Farrow's and fourple the size of mine. It is amazing how that works. On behalf of all of us at Bloomberg, Francine, next year have your birthday 5 days closer to Christmas, so the kids will be even more miserable.
Yeah, my kids don't even know it's my birthday, so thank you, Tom. It's also good memories. We need to get those jackets back, the Bloomberg surveillance jackets.
Yeah, well, they're scarce items. They're on Pawn Shop, that show out of Las Vegas where they, pawn off valuable items.
Yeah, we need to move on from that.
Speaking of jackets, Hugh Von Steen is with us, always bundled up at Davos, or maybe at Singapore as well. UBS Senior Advisor, very, very important here. Conversation on the moment that we are in particular the linkage of our markets to public policy. Futures up 22. This is Bloomberg, and it is her birthday.
mkokoteni ya stima ningeipata naweza sikia vizuri sana kwa sababu inatumia nguvu sana.
The advantage of the electric handcut over the manual conventional handcut is that one, it increases the productivity level of the users. Two, it is eco-friendly in that it does not pollute the environment. Three, it increases the income level for their users in terms of loading capacity and also in terms of productivity.
Surveillance. Good morning, everyone. Tom Keene in New York, birthday girl in London. We're thrilled that you're with us today. Hugh Van Steen is with us with UBS. Let's get right to it with futures up 22. The VIX in a full stick, 23.35. Hugh, I want to talk about the experiment of negative interest rates. You are truly expert on this and the effect on commercial banks. We're duration out 2019, 2020, and all of a sudden another year beckons, granted within this horrific pandemic as well. Is 2021 a tip point for commercial banking where they just say we can't do it in a negative rate environment?
Well, thanks for having me on, Tom. Look, my view is that the longer we have negative rates, the more the side effects. And there was a great study by the San Francisco Fed who really showed 5 years out how damaging this is. If you look at the latest ECB statistics, they're forecasting that Eurozone banks will make just 2% for the next 3 years. And I think that's why, in some ways, what the ECB did last week in extending the special funding for lending program was so important. One of my concerns, and certainly I think the concerns of many policymakers, is will the banks be strong enough to lend to small businesses to fuel the recovery when it's been such a tough environment. And I can think these funding for lending schemes continue to be extended because of the side effects of negative rates are getting more corrosive by the day.
What is keeping the United Kingdom, for that matter, what is keeping the United States from joining the negative rate experiment?
It's a great question. I mean, I think some of this is a matter of belief and some of it is a matter of fact. I mean, like we all know in economics, there's never a good experiment. But what we do know is that in Japan, who's had low and negative rates for the longest, the Japanese regional banks are the most unprofitable banks on the planet. And that's why the Japanese actually recently offered a special bonus rate to pay the banks to restructure. As you think about the Anglo-Saxon world, New Zealand, Australia, UK, America have all contemplated negative rates, but so far just said this isn't something they want to get out of the toolbox for fear that once you're there, there's no reversing. And I think I agree with Mohammed Al-Arian. There's no obvious retreat once you've gone negative. So why be tempted by this Alice in Wonderland world that none of us really want to get into, even though it's getting to Christmas?
Hugh, are banks strong enough to actually fund the recovery?
Well, first, happy birthday, Francine. I mean, I think that they are. I mean, for me, the banks are the dogs that didn't bark this crisis. They've been resilient. They've been able to lend. I mean, one concern, though, for us all is almost all lending this year to businesses on balance sheets has come from guaranteed lending. Take the UK, 42 out of 44 billion of loans this year were guaranteed. And so understandably, none of us quite know if they're strong enough. But my view is that in the main, the larger banks are strong enough to lend, and it's much more a lack of demand from small businesses who've been very cautious. But inevitably, there's going to be weak and strong. And one of the things that we've discussed before, but I'm really intrigued by at the moment, is whether the pandemic not only has accelerated the whole digital agenda, but it's also accelerated a winner takes most characteristic. And I think that's something that the stronger banks just get stronger and stronger, And I think the weaker and small banks are going to find this a really tough wicket.
But Hugh, what happens when government guarantee loans actually expire? So does it mean that small and medium-sized enterprises just won't have access to the funding that they need? Or does it become dangerous for the banks because they'll keep on lending?
Look, it's a great question. I think, like most things in life, the devil's in the detail. In the States, some of the PPP program was actually written off as grants. That's not been the case in Europe so far. And I think one of the real concerns, whether it's UK, Germany, France, Spain, Switzerland, are these loans, are these contingent, which will come back, which the firms have to repay, maybe over a slightly longer period, whether they can be written off. And then number two is the government loan or guaranteed loan senior to any new financing to fund the recovery. And I think in particular, one of the topics you've debated a lot is, as the economy recycles, some parts of the hospitality industry are clearly under still stress, notwithstanding the rebound trade. How do we fuel the new businesses? And so I think it's very important for us to make sure the pipes are clean. But I do think this overhang of guaranteed lending is something which will, the debt stack, whether it's governments or private sector, remains something which will trouble us.
Hugh, to your incredibly important piece in the FT December 3rd, folks, it's a real tour de force of, try to get it out on Twitter today. It's a huge tour de force on where we are in our worldwide commercial banking. And I don't want to go all Sherlock Holmes on you here that the dog didn't bark, but the issue is we got through this year with banking solidity. We have Japan. We have Europe becoming like Japan. Do you just assume Anglo-Saxon banking becomes like Japan and that we really have to worry about the barking dog?
Look, it's a great question, Tom, and it's something that has been a lot on my mind. Look, so I strongly believe that the larger, stronger banks have got the scale to invest in technology. I mean, one thing we'll be debating this year is, has technology accelerated us 3 years, 5 years, 10 years? Let's imagine it's 3 to 5 for a bank. You've now got to invest 3 to 5 years in the next 12 months. That requires deep pockets, and the scale of the larger Anglo-Saxon banks or Swiss banks, I think, really can pay off. But there's a real challenge for the more mid-cap banks. And we've seen a flurry of deals, and there's another one this week. That flurry of deals is going to turn to a crescendo because I think the challenge of that scale, a lack of scale, is really going to weigh on the banks. But one of the things when I did my work for Governor Mark Carney was to say that a healthy system is a profitable one. And the real challenge of Japanification is the lack of profitability and therefore the lack of resilience. And that's my concern, but I think the Anglo-Saxons will avoid that.
Hugh Van Steen is channeling Meghnad Desai of the London School of Economics there on the need for profitability. He is with UBS and, of course, formerly working with the Bank of England. Coming up, Ibrahim Rabari of Citigroup, Global Head of FX Analysis. This is Bloomberg. Good morning.
you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Tom, let's talk about oil. The crude oil glut left behind by the coronavirus pandemic will clear by the end of next year. That's according to the International Energy Agency. Now, the IEA says demand will clearly be lower for longer than expected. The agency trimmed forecasts for world fuel consumption following a new wave of lockdowns. Well, joining us now is Neil Atkinson. He is International Energy Agency Head of Oil Industry and Markets. Neil, as always, thank you so much for making the time to speak to Bloomberg. When you look at some of the potential market disruptors into next year, I was reading at Note by Standard Chartered saying we could see oil at $20 if OPEC were to rupture. Is 2020 the key year where we could see this actually happen?
Well, that's a very interesting piece of sort of could, might, and maybe analysis. Yes, it could happen if we get a combination, for example, of further significant downgrades in demand because of the COVID-19 crisis is prolonged, and at the same time a breakdown of producer discipline on the side of the OPEC plus producers. But so far, that actually hasn't happened. Compliance with their agreement has actually been pretty good.
Okay, I like that. It could, might, and maybe. It seems very surveillance-like. Neil, when you look at OPEC, so it will meet on January the 4th to decide whether the market can take more oil after the 500,000 that it will add to the market next month. Could the market actually take that much oil?
Well, in the balances that we've published this morning, we've assumed as a scenario, not a forecast, that they will increase by 500,000 during the early part of 2021 each month. On that basis, and on the basis of no further deterioration in the demand outlook, stocks do actually draw in the first part of 2021, although not by very much. So I guess the message we're saying is there is not much headroom for them to supply more oil than they currently anticipate into the market. And it's also worth pointing out, by the way, that in the official communique, which was published at the end of the OPEC Plus meetings, they talked about this plus 500,000 barrels a day each month. But in one of the press conferences following, I think it was the Saudi minister, that said that could be 500,000 barrels a day plus or minus. So there is a suggestion that the implementation of the revised deal could be flexible. And indeed, we've praised the current deal as being flexible and sophisticated, and it shows that they are concerned about the short-term fragility of the market. They're recognizing it. That's why they've got this monthly procedure, which, as you say, they meet again for the first time on the 4th.
You know, other than Adam Szymanski and Paul Sankey teamed up at Deutsche Bank years ago, I don't know anybody who's pounded the spreadsheets of oil supply and demand like you have. Is your work with Platts, what you did at the EIA, whatever it is, all these different firms, and now at the International Energy Agency. How about a could, might, maybe question? Do you believe the spreadsheets? Do you believe the actual reported supply and demand integrity that we're modeling now for next year?
Well, you've hit on a very important point. I mean, I've been looking at these numbers on and off for very nearly 40 years. And there's been a huge improvement over that period of time in the quality and timeliness of data. Now, that's great. And for the OECD countries, for example, we have pretty good data. It could be better, but it's actually pretty good. The problem we have got is largely in the non-OECD world, where, for example, China. Now, the number we describe as demand for China is something that's actually derived from our assessments of net trade, refinery runs, domestic production. It's not an officially published figure such as we have for OECD countries. And the other big uncertainty we have is the level of reported oil stocks in China, which is also not an officially reported number. Now, before banging on too long about this, because as you can guess, you've hit on something here, we were in a meeting fairly recently where we pointed out that the number of countries that are reporting data to the Joint Oil Data Initiative, the JODI initiative, has fallen in the last 5 or 6 years from a relatively large number, 36 odd countries reporting data, now down to only about 14.
Wow.
So if anything, we have less transparency than we did have. And just a final point here, this is a factual point. There are 19 countries that are part of the OPEC Plus supply agreement. And the last time we looked, only 8 of them actually supply data regularly to the JODI initiative. So transparency is not what it could be. And I accept your premise at the beginning of this little segment that data transparency is not all it could be. And yes, the underlying picture could be different from what we're seeing, although, frankly, I don't believe directionally we're wrong. We called that correctly.
It was a little segment, but it was rather informative, to say the least. Neil Atkinson, thrilled that he's with us today. With IEA, the head of oil industry and markets, and truly decades of experience of gaming supply, and what I try to focus on, the always difficult oil demand that you see. We do this with oil right now, $50.44 on global Brent. American oil, $47.15 as well. I want to look at futures, within the range. Dow futures set 29,935, up 154. SPX up 21. The VIX 23.39. We'll see how that opens up here. 2-year yield is my number one statistic today, 0.1170. Coming up, the gentleman from Lazard, Peter Orszag. This is Bloomberg. Good morning. This morning, Tier 3, hard lockdown, full lockdown, a third wave, it is all the same. The COVID virus spreads exponentially. Cases to hospitalizations to death. Do something now, there is a vaccine, but 600,000 American deaths extrapolates to the 4th of July. Here's the door, what's your hurry? Well, it's all the same as the Attorney General exits. And, well, the U.S. 2-year yield, it drifts ever lower. It is all the same. Chairman Powell, he will have limited degrees of freedom. Fed Day here, I believe it's tomorrow. Good morning, everyone. Bloomberg Surveillance, I'm Tom Keene, recovering from a birthday and in the trenches of a December 15th birthday. Francine Lacroix with us as well. Francine, it's un-American.
I thought we were moving on.
Francine, it's un-American to have lasagna with pesto. Discuss. You put pesto with lasagna?
It's Genoese. It's my mother's secret recipe. It's actually the best thing in the world, Tom. It's, I think, from like 18th century, Genoese recipes, and that's what